HMRC are very good at coming after you if you've underpaid.
Yeah.
They're very fast.
And they're like property people because they can't run anywhere.
You know, if you've got a £500,000 property, only got a £250,000 mortgage on it, and you drop it into a limited company, in essence, you as an individual now, or the partnership, have gifted £250,000 to the limited company, and you can pull that gift back out of the net profits.
Paul, when it comes to stamp duty, people don't get super excited by it. It's something that the solicitor will present to us at the time of purchase. This is what you're going to pay, get it paid. But I found out recently there's about £2 billion a year we overpay in stamp duty to the taxman. And meaning about 25% of stamp duty has some kind of error in it or another. How's that even possible?
The answer to that is quite simple and complicated at the same time. Stamp duty used to be a very simple transaction. You bought a house, there was a rate, and you paid it.
Yes.
Over time, the government brought in various reliefs and exemptions for various different parts of that transaction. But unfortunately, you need to be a tax advisor to work out where they apply. Now, traditionally, everybody goes to the completion point, and your lawyer, who's unfortunately the end of the chain and the person that's left with this to do because nobody else wants to go anywhere near it, then presents your stamp duty calculation to you. But he's not a tax specialist in any way, and the only thing he's been able to rely on is a calculator which is run by the HMRC, which is clearly biased towards the HMRC, but it doesn't really give you the route unless you know what you're doing as to what all the reliefs and exemptions are, because it's all about tax. So they just use the calculator as best to their knowledge, which ends up 9 times out of 10, if not more, with a highest rate calculation being done. Because at least you've paid the tax.
It errs on the side of caution as opposed to what might be the right amount of tax.
Yeah.
And we leave it to the solicitor, the conveyancer dealing with the purchase for us, because many people think that's just part of the process of what they do, find the searches and raise inquiries and various other things. But as you point out, actually it's an area of taxation, and it's probably a specialist accounting thing rather than a legal thing.
Yeah, again, accountants don't like going anywhere near this because it's a mix of law and tax.
Okay.
And property analysis.
Yeah.
Because it's not just about the bricks and mortar, it's about the people who are buying it.
Yeah.
Their tax history, their property holdings, what the property actually is, as opposed to just bricks, where else is involved in it.
Yeah.
I mean, the simple one is it got a granny annex.
Yeah.
But what qualifies as a granny annex? And that's the bit that most people don't realise. It's not. Yeah. This is where it gets really complicated then.
Yes.
And you need a bit of a specialist to do that.
So if it's a bog standard family house, and investor is purchasing 3-bedroom little semi that's going to go into their portfolio as a buy-to-let, could they still get the stamp duty wrong on that?
They may well, I always say, like, if it is Mr. and Mrs. Smith, they're selling their 2-bed, and they're buying a 3-bed, there's no other property interest, there's no other interest, it's not going to be changed anyway. That will be standard.
Yeah.
But if it's Mr. and Mrs. Smith, who were not partners before, they're both ex-divorcees, if you like, and one of them's got a buy-to-let and another one's got an inheritance, suddenly we're now into a different world. Even though they're still selling a 2-bed and buying a 3-bed, now there's more involved in this. It has to go into the mix because it may change the rate one way or the other.
Yes.
And this is where it starts getting complicated.
Yeah.
And these are the errors that we started picking up on. 2017?
Yeah.
Was when I started picking up on this with a few of my other guys.
Yeah.
And it just blew our mind when we worked it out, and the statistics that you were talking about were pretty much given to us by a very high-level legal firm.
Yes.
Because they did their own internal audit once we presented the thoughts and solutions way back.
Yeah.
They did their own internal audit, and they came back with these numbers, which subsequently, in work that we've been doing now with legal and financial firms, it can be worse than that.
Yeah.
We're always edging on the side of caution. I mean, I now know that of calculations that we're doing through a calculator that we've created, that over 50% of all calculations need tax advice of some form or other. I wouldn't say all of those would qualify for relief, but at least they need to be looked at to see if they do qualify for a relief. And this just blows our mind when we see this.
Yeah.
Yeah.
I think it's 2016 probably when I first started realizing actually there's a lot more to this than just the form that you complete. There was a number of deals we completed just before some major stamp duty changes, and then after that event started realizing actually there's many things going on. As you said, there seems to be constant changes happening. I was speaking to an investor recently from overseas, and they've got to pay an additional rate as well when they're buying property in this country. So there's so many different levels. So let's talk about a typical example of, say, somebody's purchasing a property that it might have been 3 flats in its a real state. Maybe it's a probate as well. So there's a number of things going on there. How could something like that be a classic case of actually it's not going to be probably what we think it is, the stamp duty?
Okay. In probate, if you're a developer and buying out a probate and you're going to develop the property and do something with it and flip it or sell it or whatever, then there's an exemption straight away built into that.
Okay, yeah.
There are rules around this. I could talk for hours on the different complexities, there's no point, but there are exemptions for probate purposes. Yes. The other one, which is quite a common one, is an uninhabitable property.
Yeah.
There are a lot of reclaim companies now touting for this business. Or have you bought a property that's uninhabitable?
We get several letters a month.
Yeah.
Yeah.
I say to people, be careful. Uninhabitable, it literally means under HMRC rules that it's pretty much a derelict property.
Yeah. Not just missing a kitchen sink, for example.
If it's
from a mortgageability point of view.
Yeah. For mortgageability point of view, sometimes say it's uninhabitable because you've got damp in it.
Yeah.
That doesn't really qualify because you can fix the damp in it and rent the property out.
Yeah.
It literally has to be a shell in its purest form. A shell or in a dangerous state is probably another simplistic way of putting it.
Yes.
But that's another one that is common. The granny annex is another one that's common. But what qualifies as a granny annex or an additional building?
Yeah. Again,
there are rules around this, and there are people trying to get claims through and whatever. But what we're looking at is helping people before it becomes a mistake.
Yeah.
Rather than correcting the mistake.
Yes.
We're at the front. We're really trying to educate people to understand that the problem around stamp duty is there, and to open their minds up to be aware that you need a tax advisor to give you the correct rate, and don't always rely on your lawyer to give you that rate, because he's not qualified to do that.
Yeah.
And in fact, you will be finding in time more and more legal firms are actually completely standing away from any kind of stamp duty work at all. They are rapidly letting their clients know, we don't calculate stamp duty. You need to talk to a tax person to get it correct.
The risk of it backfiring afterward because it's now becoming so complex.
Yeah, because it's become so complex, it's backfiring on the lawyers. They are seeing lots of file requests from claim companies saying, we think the client's overpaid. If the client's overpaid in the last 12 months, it's quite easy to correct.
Yeah.
It's a simple error. It's an error to correct. Beyond 12 months, it's a mistake, more difficult to prove.
Okay.
A mistake has happened. Beyond 4 years, you're into the realms now of who's responsible.
Okay.
The person that filled in the form, potentially under true law, I presume, but whoever fills it in is the one that's doing it. Well, that could be the lawyer. So this is why a lot of legal firms are going, hang on a minute, this has become too complicated, and it's becoming an issue for them.
Yeah.
So that's why we're working with legal firms to educate the clients ultimately that there is an alternative now that you need to think about. There's another, as we put it, there's another cog in a property transaction. There's a financial cog, there's a legal cog. The one everybody misses is the tax cog, because there are multiple taxes involved as well.
Especially from an investor's point of view, because the whole objective is you're making, you're entering into a venture to make money from that, whether it's going to be rental income, whether it's going to be capital growth, whether you're going to be developing or selling. The idea is you're looking to make money from that particular investment. If there's ways you can make a significant difference in just saving, clearly it's gonna help. Yeah,
definitely. There can be a lot of money that's saved. I mean, one we're talking to at the moment, he was advised, it's a decent purchase, it's £3.9 million property, okay. So it's not small. It's actually kind of a farm, basically, that's been converted. It's got outbuildings. It's got lots of going on around it.
Okay.
His original calculation by a lawyer using the HMRC calculator, and because he's not a taxman, was £500,000.
Wow.
So we've looked into it with our tax teams, into that calculation, and based on the information that's provided so far, the actual duty is 180 grand.
Okay, so it's significant.
£320,000 saving.
Yeah.
That guy, as you can imagine, is quite interested in talking. Now, he's a savvy developer.
Yeah.
He's actually quite a businessman in London, and he's prepared to pay for the certified advice because he's going to save money. And we're seeing lots of these appearing now, coming out of the woodwork, that they would have potentially paid the £500,000 before.
So there's two things here. Firstly, it's at the point of purchase, making sure you're paying the right amount in the first place. That's just what we're talking about. Or if you've already purchased, there's a period of time that you can go back and relook at what's happening depending on how far back you're going. So if someone purchased something 12 years ago and thinking, maybe I might not have paid the right stamp duty, it may not be worth kind of pursuing that.
Yeah. Anything up, if you bought something in the last 12 months and you think you might have overpaid the duty, then yes, you can potentially get looked at, and if there is an error in that calculation, then yes, that error can be corrected. You need a tax advisor to make sure it's correct, of course, and you get certified advice. I'd always recommend that, so that should the problem reoccur, because HMRC have the right to relook at things like you do. It works both ways. 12 months is reasonably easy. Up to 4 years, yes, you can, as long as you prove a mistake. Beyond that, yes, there's a potential, but now you're potentially going after the legal advisor.
Okay.
Which, do you want to sue your lawyer? There are people appearing out the woodwork who are, in fact, creating businesses for you to do that.
Right.
But you are in an area, is it economically worthwhile? I mean, if you bought a £5 million property and overpaid £1 million worth of stamp duty, clearly would be. Or if it's small, probably not. But you can go back, I think, 20 years if you really wanted to. It's limitless, really, if somebody's done it.
And it's only in more recent years it's become more and more complex.
Yes.
Previously it was much more straightforward. How it used to work anyway.
Yeah. But when stamp duty first came out, it was, you buy a house for £500,000, that's the rate you pay.
Yeah.
Then they go, hang on, the first $250,000 you don't pay a rate, the second one you pay a different rate. Oh, by the way, the developer wants to do this, so they change the rules, and somebody changes the law, somebody challenges the law, creates a statute which changes the ruling.
Yeah.
These have all gone on in the last 10, 15 years.
Second property, investment property, overseas investors, all these things, it just really complicates how it's done.
Yeah.
I guess for most people, you just jump on the HMRC calculator, stamp duty calculator on their website, work it out, throws a number out at you, asks a few questions. And I've seen other calculators which ask fewer questions and produce a similar number. So you think it's fairly straightforward. And I'm guessing the lawyers probably just use the HMRC site when they're doing the calculation. But you said what that's really doing is erring on the side of caution and coming up with a number that's a safe number, and it's probably or at least a quarter of a probability that might be incorrect.
Yeah, it is. The HMRC calculator, it really asks you the basic questions. It doesn't ask you if a relief. The reliefs are there, but you're going to know where they are and how to apply them.
Yeah,
it doesn't really ask you the right questions to enable you to do that.
Yeah.
So you end up paying a higher rate because you just end up doing the simple questions. A lot of in fact, most of the other calculators that you click on to do the same thing through financial advisors, through other networks and platforms, are all basically taking the same idea and calculation. So it takes the basics.
Same methodology.
Yeah, same methodology. How much is it? It applies the basic exemptions, which is first $250,000 you don't pay, and then you pay the rates above it. But then it doesn't ask you anything beyond that. And the one that we've created for the legal and financial industries is more intuitive.
Okay.
So we've created one in conjunction with the tax team, who are joint venture specialists in it, to actually create something which is much more intuitive into the questions. It does ask you some of those basic exemption questions for you, and then it subsequently asks you further questions. So it is quite complicated in the background. But it actually gives you an answer which then says this client needs to talk to somebody rather than this is the rate. It gives you something. But all we're trying to do is enable people who are buying properties the route to get correct advice, and to understand that they need advice. That's the biggest question.
It's the taxation is just not on the figure of the purchase price, so it's not just based on the property; it's also based on the buyer's circumstances as well.
Yes.
So it's not really just a case, well, this is what you're paying, so it's based on a percentage of that. What type of examples are the most common where they're making mistakes? What type of purchases would you say are common errors?
The big errors, the common errors are mainly around transfer of equities.
Okay.
Now, because it becomes complicated straight away. So, if a couple are splitting up and then another party is coming into it, what happens with the stamp duty? To all three parties, because one's going off to buy another property himself, but he was on the deeds with his partner. They've split it up. She's gone, well, he or she or he or they or whatever. They've got a new partner coming in. What's their history? What have they got? What are they taking on? The liabilities and everything else. This suddenly it's very complicated, and that's just a simple one. If that then expands out and they both had previous properties and so on and so forth, it becomes even more complicated. I mean, a little simple one, which I'll just, if you don't mind, I'll just explain. It was given to me the other day by a guy whose parents have a flat, and they want a 2-bedroom flat, but they can't find a 2-bedroom flat. It's a retirement home type place, so they're now going to buy 2 flats, so they live next door to each other. And put a door through, so they can communicate. Now,
they're 2 separate properties.
But they're 2 separate properties, but they've still got their existing property. Question is, they're going to pay the 3%, aren't they?
Yes, because it's additional property.
Additional property. But if they sell their main residence, which is one they've got at the moment, then they can reclaim the 3%, can't they?
So the bit they've overpaid, they can get back because they've only ended up with just their home.
But can they? No, they can't.
In this case, they've ended up with 2 properties.
So they can't.
Yes.
Neither of them can now. Because they're not actually living together.
Yes.
So they're not changing, they're not disposing of the main residence and buying a new main residence for the 2 of them. They're buying 2 separate residences. And these are just...
And if they're like a couple of $100,000 properties and there's...
I think they're about $200,000 each.
Okay, so you're probably talking, and if there's 2 properties, probably like £12,000 or so quite easily.
That they can't get back. But if they were to look at it properly and do it in a particular time scale, which is actually probably what is going to happen anyway, then they will be able to reclaim 3%.
Okay.
At the moment, they would just pay the 3% extra. Or they might actually get an exemption on it and realise they've underpaid and end up with something they've got to overpay. So people can underpay as well.
Yes. You could work the other way. I
mean, I tell you, HMRC are very good at coming after you if you've underpaid. They're very fast.
And they're like property people because they can't run anywhere.
Because there's a property, something physical they can go after if you don't pay. They can go for an asset. But they don't tell you if you've overpaid. They'd never tell you if you overpaid. Why should they? Just your right to claim back off them, it's their right to claim it off you.
So in your declaration saying this is what I pay, and when the solicitors completing the forms, they're completing them on your behalf. Aren't they? It's not that you're signing to say this is correct.
In the truest form of law, it's a self-assessment form. But lawyers have a legal obligation to ensure that you do it correctly and it is correct. Under their own rules and the SRA rules, they're under obligation to make sure that you pay your tax because they're doing it for you. This is where it gets grey now. Now, the SRA, the regulatory authority for lawyers, are clearly recommending quite heavily now that lawyers do not go anywhere near stamp duty. Because they're seeing so many problems with it.
So they're starting to see maybe claims being made against professional indemnity.
And in fact, I've seen the same thing now with financial advisors. We've seen various messages through the networks to say, don't go anywhere near stamp duty. Do not give anybody a calculation on stamp duty. It's a minefield of issues. Accountants is another area. We've seen a story of an accountant actually being closed because they gave advice which they were not qualified or competent to do so. So
effectively they're giving tax advice that they're not supposed to be doing.
There was an underpayment by $250,000 by a client, which they calculated. The client subsequently went after, said to them, I've had the taxman after it. And they said, that's right, we'll claim on our PI. And then the PI company walked in and just refused the claim. Because they stated then that the accountants hadn't got sufficient knowledge to be able to perform
advise
that advice
in the first place.
I mean, there's a lot more behind that other than that.
Yeah.
I'm being very, very simplistic.
Sure.
There's a lot more behind it, but in essence, that resulted in that firm having to close because that liability.
And I guess the impact happens on the solicitors when they have a claim on the PI, that the cost increases next time around, just like all insurance policies. Once you made a claim, it'll increase significantly. And we're not talking about small premiums that they pay, very large premiums that they pay, and it can leave a legal practice in a position where they just can't carry on functioning because the PI cost is too high.
Yes. Yeah. That calculator helps relieve that because the problem is, as far as the PI companies are concerned, is that there's a potential error which you're not really addressing.
Yes.
If you're addressing it, i.e. using something like we've created that actually points the clients to tax advice, clearly now you're mitigating risk because you're actually, even though you're not calculating the duty, you're making the clients aware there's an issue, you're making the clients aware they need to get tax advice, and you're qualifying that they're actually doing that. Now there is less of a risk for you, so your PI company will look at you and go, actually that's a really good idea. Therefore you are limiting your risk. However, as we warn lawyers, you've got to do all of them or none of them. You can't do half. You can't cherry pick because the PI company can say, well, Ben, as you didn't do that one, but you've done that one, you're still doing your own tax advice because you're working out which ones you should do or shouldn't do. And we've found all this out because we're working in one of the largest legal conveyancing companies in the UK. And we are both doing risk training and not tax training, but how to use the calculation system correctly. And we're saying we're listening to their risk advisors, their own internal risk advisors, saying you have to use this 100% of the time. If you don't, you cause your own problems even more. So it's definitely been identified by the larger, and I'm talking the large corporate big houses, that there is a big risk here. And when I work through the numbers with the owners of the business, it's frightening how big it is. Because like right at the very start, you talk about £2 billion a year. That's a £2 billion a year risk that somebody is taking on.
This is true.
Would you like that?
No, not at all. When it comes to limited companies, which more and more investors tend to be buying in now, how's the stamp duty different there? Because it's not the same. It's not treated the same way.
No, the rates are slightly different for a limited company. So when you're an individual, you've got various different exemptions. Whereas a limited company, you've got a standard rate that applies. There is an exemption that instead of it being $250,000, it's 150,000 or whatever before you pay the rates. But then after the rate just stays at as a more standard rate. But the exemptions that we're still talking about still apply. Things like the granny annex, things like multiple dwellings, things like mixed use buildings and things like this. They're all those different reliefs and exemptions still apply. But we still have to look at the internal structure of the limited company as well, because the shareholders have got to be UK based. If they're not, then that can trigger off the 2% surcharge for non-resident rates. So,
and if someone's purchasing a property from a company versus buying the company that owns the property, then the stamp duty they're different again.
You've got the stamp duty rate on a building, which is one rate, and then there's a stamp duty on the shares. So if you're buying a property development company, you'll pay your stamp duty based on the shares of the company, which those shares values will be based on the assets and everything else that accountants and everybody works out. But if you're buying the property out of the limited company, then you'll pay the stamp duty on the rate of the property itself. As personal or limited company, whoever's buying it. It gets very...
absolutely. And I can see how it's kind of just become a bit of a minefield. And I've had a number of, arguments, let's say heated debates with some solicitors about what we should be paying on stamp duty on some purchases for ourselves and others as well.
I mean, I've had conversations with lawyers that they have spent two partners 3 hours each trying to calculate a stamp duty. Both are arguing over different points of law. And guess what? They're not charging the clients for that. Lawyers are doing something they're charging. Yay! Where does that come from? I don't think anybody thought about that one before. And then it got passed to us, and within 25 minutes we gave them a certified answer. One of them was correct and one of them was wrong. In fact, I've had occasions where both of them are wrong. But they're doing this for nothing, lawyers. And again, they're going, well, hang on a minute. Lawyers don't do nothing for nothing, do they? Well, I have been for many years, calculating stamp duty. They charge you for actually doing the filing, but they don't charge you for calculating. But there we go.
Yeah.
And the other one that a lot of people talk about, and in fact, I had a very interesting conversation with the lady yesterday, is about portfolio clients that own property, dropping them into a limited company because of all the tax advantages of doing it. Yeah. But I really open the minds up, because when you do that, it's not one tax. There's about 4 coming into play. You need 4 costs that you need to be aware of. So clearly, if it's an individual that owns a property on his own, like yourself, Sarge, and you want to drop it into a limited company, when it goes in, you'll pay a stamp duty on the drop-in, because it is an individual.
Technically, it's a sale.
Technically, it's a sale. If it's a partnership, you and a partner that have owned this property for some time, you've traded it, not last week, but you've traded it for a while, tax-wise, and then you decide actually it's more beneficial to drop it into a limited company, then yes, it drops in. There's an exemption for stamp duty.
Yeah.
Yay.
LLP route.
Yeah, the LLP route. Don't do it in the same year, whatever you do, because that means you're avoiding tax.
Yeah.
Like, do it in a different year. However, the bit that people don't understand and they don't get sold is actually there's a capital gain going on now, because you've got to transfer at market value in essence. So there's a capital gain going on. So that's got to go in. The different rates on mortgages that are applied between limited companies and individual thing, that's another bit to go on. You've also got different equity rates between the two. That's got to be put into the mix. And then the final one is then, of course, you've got accountancy fees on a limited company, which are a lot higher than the self-assessment returns. That's got to be stuck into the mix. When you stick all that into the mix, you go, hang on, is this really worth it or
You've
not?
got to really look at whether it's
You've got to look at everything. It's not just look at this, I'm going to get rid of stamp duty, look at everything else. However, the benefit on the other side is equity is classed as a director's loan. So, you know, if you've got a £500,000 property, only got a £250,000 mortgage on it, and you drop it into a limited company, in essence, you as an individual now, or the partnership, have gifted £250,000 to the limited company, and you can pull that gift back out of the net profits.
Yeah, because there's no tax on that, because it's your money.
It's your loan. Yeah. It's a loan that you've loaned the company. In essence, you've loaned your money as a mortgage, in essence, to the property company, and then you can pull it back until it's exhausted.
Paul, what we've established that this can be very complex area when it comes to stamp duty.
Yeah.
And as you mentioned as well, there's a lot of companies being set up now trying to chase and pursue these type of transactions, and not all of them necessarily may be ethical in terms of how they approach. Our conversation has been very insightful for me. What is it that somebody should be looking for in who they should be picking as a guidance and advice for them in their stamp duty?
If you're going to get advice on stamp duty, make sure they're proper tax advisors, right? I mean, they can connect to us with the greatest of pleasure, because we're advising the professionals. We end up talking to you through those anyway. But yeah, get some proper tax advice. And I always say to people, make sure that tax advice is certified. So a lot of accountants say, yes, I can do that. A lot of financial advisors say, yeah, I can do that for you. A lot of mates in the pub tell you what it is. But then say to them, okay, that's great. If I have an inquiry with the tax office, would you be able to stand up? Will you stand up with me with the potential to defend it? That usually qualifies if somebody's giving you advice correctly or not. And you know that we use occasionally where somebody we know is overstepping the mark. But at the end of the day, it's your self-assessment. You know, if you want to take that risk on personally, good luck. I wouldn't, because I know the HMRC, because of the reclaim companies that are appearing, and some of those legit, a lot of them are legitimate, because there are definitely claims out there, but a lot there aren't. I've seen stories of others that are really pushing the boundaries of this, and that is a flank to the tax office, and then they're starting to jump on. I know they walked into an office recently and literally shut the business down, basically, because they were doing reclaims, or they told the company they were going to close them down, basically, because there were so many errors that they were making in these calculations. So the tax office, the HMRC, are aware. They are acutely aware of reclaims and companies appearing to do reclaims, and that's where they're going. So, of course, you know, make sure that the advice you get is good advice. That's what I say.
Yeah, one thing is what's already happened in terms of things you've already purchased, but whatever you're purchasing,
yes,
just being mindful of that actually you're paying the right rate is key.
Yeah, but be mindful that rate may or may not be correct. Just question. That's why I always say question. How did you come by that calculation? And if they say I use the HMRC right, say can I get an independent review?
Yes.
I mean, we do it independently. Basically, we do what we do for free.
Yeah.
To work out if a client needs tax advice,
Yeah.
the calculator that we've created for the financial and legal people is free to use.
Yeah.
People pay for certified advice. That's where the revenue comes from. People pay for certified advice. But people will only pay for certified advice if they need certified advice.
Yeah.
If you don't need it, you don't pay for it.
Yeah.
We're trying to make it as robust as we can. So it's all about trying to help people. Make sure there's such a market out there. We don't need to sell this. It's all about we just want to help people.
Awareness, yeah.
Make people aware and help people make sure they're paying the right rates. That's what we do.
Hey, Paul, this has been a really insightful conversation for me, as I've said as well. And I was just blown away by how many different variations there are in terms of inconsistencies in the calculation people might have in stamp duty. Appreciate that. Thank you so much.
Thanks, Sarge.
It's a pleasure.
Speak again soon.
Thank you.